Well, hey, it's a pleasure to be here. Really appreciate all the support. You do some great coverage of the space, and appreciate your coverage of Marathon. So, thank you.
Well, I'm glad you appreciate it. It's been quite a journey, and following you guys and your growth has been certainly a pleasure to watch and be a part of. It's interesting the way things developed and the way my own channel has grown through that same time, and just it's witnessing that maturity suddenly surge throughout the Bitcoin space, and then also being able to become a part of it in some sort of public way has been quite rewarding.
That's great. It's great. I always think it's on one level somewhat of a thankless job, operating a YouTube channel, just because there's a lot of work. Most people don't realize how much work goes into filming, editing, promoting, thumbnails. You've got to, et cetera, et cetera, et cetera, show notes, all that sort of stuff. It's a lot of work.
It's a ton of work, and it doesn't pay that well until you really, really make it big. But it is fun, so you really got to be doing it for the fun of it. Otherwise, it will drive you crazy.
Yep, absolutely.
But so there's a lot of stuff. I mean, I know you and I were supposed to talk on Monday, which I was looking forward to that originally because Bitcoin's birthday, and I had intended to kind of kick the interview off, talk a little bit about. I'm not sure how much you've looked into all this, but if I'm curious, have you ever actually looked at the Genesis block and things like that?
I have seen it. And the embedded comment about the chancellor and increasing the lending in the UK. This is 2009 that happened, and it's interesting. The one of your colleagues in the podcast YouTube world was saying, I think it was Nick Carter maybe, who was saying that you look between when the Genesis block was first mined and then the next block afterwards, and there's this lag, and was it Satoshi kind of experimenting and resetting the counter, or was it God created the earth and then rested?
It's funny because I think it is 6 days between the two.
Yeah, exactly.
I never even thought of it that way. That's interesting.
I thought that was kind of funny to hear. So.
Yeah, along those lines, it's what many people don't realize is that that first Genesis block was actually, it's theorized that it wasn't mined. I mean, Satoshi's never commented on this, but because it's the only block in the Bitcoin blockchain that doesn't point to another block.
Right.
So it couldn't have been mined, not using mining software as it exists.
Mm-hmm.
So it wouldn't have worked. So it had to have been constructed. And that's where a lot of people theorize that it points, the timestamp on it was artificially placed to bear the relevance to that message. And that he actually started mining 6 days later. It's just reflected in that way. But because of the fact that there's no pointer in that block, the coins mined, quote unquote, are not spendable.
Correct. Yep.
So he couldn't even. That would be the only argument you could make of a pre-mine. But even that, they're not even spendable, so you can't even count those.
Exactly.
So I guess that's technically 50 coins out of the 21 million that right away are not even, or you can't even really count them.
Exactly. So we're at 20,999,950.
Yeah. Or pretty close to. I didn't. Yeah. There's a lot of interesting stuff when you get into the weeds of Bitcoin and study the technicals and how the protocol functions. There's a lot of nuances that come to light, and it really gains you an appreciation for how well thought out it was. Mm-hmm. Considering at the time, there's no way he could have known this was actually going to work. So to get it so precise and anticipate so many different things, it's remarkable.
What people a lot of times don't understand about the difference between, for example, Ethereum and Bitcoin, is, Ethereum is essentially a very centralized protocol, right? There are a handful of people that can determine to fork it right away or whatever they want to do. A lot of the Ethereum is in circulation is actually controlled by a limited number of people. And Ethereum is a great protocol or network on which to do development work because it's programmable. But it's kind of like that ease of development also means people tend to roll out things before they're really fully baked. And that's why you have all these issues of a lot of these DeFi products having errors in smart contracts and causes for concern regarding security. Whereas in the Bitcoin blockchain, just look at the effort it took to get Taproot through. And you see that, it definitely, you have to get everybody on board to make stuff happen. But because of that, it's a very secure and robust network. And anybody who wants to really roll out an application where security is your primary criteria, then the Bitcoin blockchain is the only place to put it.
Yeah, I would agree with that. I mean, as you may know, I'm a big fan of Ethereum as well. I looked at the two as very different, and you're absolutely right because well, Bitcoin has a very different culture within it, and that culture is, well, one, don't don't mess up a good thing. It already functions, and for its purpose, it's nearly perfect. There's not a whole lot more that needs to be done to it. The reality is Ethereum has made trade-offs to accomplish its goals. It's that move fast and break things. They're not afraid to push that envelope, which it could have its benefits, but it also carries a significantly higher level of risk. If you do that on top of hard sound money, but luckily Ethereum is not trying to do that. It doesn't need to do that. Bitcoin already does it. So it's trying to do something completely different.
It's interesting when you look at the the world of DEXs and the world of DeFi. A lot of these applications being developed on Ethereum or Solana, Avalanche, et cetera. I think that whole world is going to be a really interesting pool to be looking at over time because there's no guarantee that one is going to be the king of the pile. There may very well end up being multiples that exist. It's not like the search engine world where at the end of the day, you only really need one really good search engine. In this case, I think there are going to be lots of blockchains for various applications and use cases, right? A healthcare blockchain may be very different from a supply chain blockchain. You may have more centralized type blockchains and more decentralized type blockchains. There are all sorts of alternatives out there, which are all very relevant depending on the business cases you want to use them for. And I think, Bitcoin is a great store of value. It's a great settlement network, and there's all sorts of great things you can build on layer 2 and above in the Bitcoin blockchain. But the same applies to Avalanche, Solana, Cardano, Ether, et cetera.
Yeah, and it's interesting because that's going to play into a little bit more what I'd like to get into in talking with you, because one of the things that is, the more you've been in this space, the more you realize is that every decision, every choice that is made always comes with a trade-off. There's always a trade-off, and that goes for Bitcoin mining as well. So it's going to play into a little bit more in our conversation as we're going to go forward. So with that in mind, I guess one of the other things, before we get started and all that, I wanted to talk a little bit more about yourself. You've done a lot of talks, a lot of interviews, but in doing a little bit of my own research into your history, you've got a long history in the public space. What do you find, what's the biggest difference between your experience in public companies before Bitcoin and now?
Oh, gosh. It's a great question. So I think, my first kind of experience as running a public company was over 20 years ago when I took a company called Lantronix public. And, we were in the revolutionizing the world of IoT. It wasn't even called Internet of Things in those days. It was called, how do you take a device that's not a computer and connect it to the internet and control it? And we were connecting alarm panels, lighting systems, health devices, industrial automation systems to networks. And we felt, back in 2000 when we did the IPO, we felt, everything's going to be connected. Your toaster is going to be connected to the internet. And here we are 20 years later, and my toaster still doesn't talk to the internet. But change takes longer than you think. But it's really interesting because many industries, technologies need a key enabler for them to become big. The Internet of Things really was highly dependent on the smartphone, right? The Apple iPhone, the Android phone, it's a ubiquitous human machine interface. The minute you had this ubiquitous machine interface, all of a sudden, all of these layer 3 applications on the internet became totally viable. Video streaming, for example. The vast majority of video that's consumed, think about it. Most of your audience, I'm sure, views your program on an iPhone or an iPad.
Yep.
They don't view it on a laptop. And so you look at the impact of the iPhone on how it allowed it was kind of a very disruptive technology, but enabled a huge industry to be built on top of it. I think as you look at the crypto space, you have a similar thing happening, which is just people are realizing the value of blockchain technologies and the value of digital asset technologies. And so you're seeing adoption starting to happen. And it's like we're in 1997 of the internet. It's kind of what I tell people. It's, imagine the Bitcoin blockchain is TCP/IP to the internet. And look at all the things that will be built on top of that. And that's where a huge amount of value is going to be created. So I think if you think about operating a public company in this space versus other spaces, this is very much like operating an internet company in 1998. If you go back and you talk to people who were the starters of Webvan and all these companies that raised hundreds and hundreds of millions of dollars back then, and you were to talk to the investment bankers, they were saying, you've got to lose more money to grow your market cap. This industry is an industry not where not that anybody's losing money in it, ideally. We're all making a lot of money. But you got to grow, you got to grow, you got to grow, and the markets want to give you money. And so there has been a lot of money coming at all these Bitcoin mining companies. And at some point, that spigot is going to get shut off.
Yep.
Because, there are arguably 24 public companies in the space today. There will likely be 30 soon. How many public Bitcoin miners do investors want to invest in? Well, there's going to be some level of consolidation. And I think over the next 5 years, you'll see the mining space look like many other technology sectors. You'll have a handful of very large players, and then you'll have some unique niche players, and there won't really be a lot of space for people in between in this space. And I think, the power companies, as I've said lots of times, are coming into this space in a big way. And over time, the constraints that exist around hosting, power, and machines are going to totally disappear. And then it's going to come down to who can operate most profitably in this business. And that's going to come down to your ability to be agile and move. What's unique about this business that I've never experienced previously is that this is the first time I don't have to worry about a sales pipeline. This is the first time I don't have to worry about customers. We mine Bitcoin and we hold it. Our single biggest stakeholders are the Bitcoin community and our shareholders and our employees. Right? I don't have customers that I typically have to keep happy, that I have to differentiate my product versus the competition, right? Riot and Marathon, we have to make the same Bitcoin because that's what the market wants.
Yep.
We can't differentiate our Bitcoin from each other. So we have to differentiate our businesses and our operating models instead. So it's a different, it's a very different kind of way of competing. And I think that's the biggest difference. It's capital efficiency, return on assets. So it's very financially metric driven. And then it's just operational excellence.
Yeah, it's kind of, you're at the your opposite end of the, it flows in the opposite direction because you're not trying to attract customers. You're trying to attract capital.
Yeah, exactly.
And that's really how, because the flow goes in the opposite direction. You don't have your product. Ideally, you stockpile it. it's not too many industries where that's the incentive. So
I mean, not
it's
even in the gold or the diamond industry. You know, in the gold industry, look how many gold miners actually stockpile their gold. They don't. They sell it.
yeah.
All right. Oil industry, they sell it. Diamond industry, they sell it.
I think
Bitcoin
that's
industry, we hold it.
yeah. It's the only thing that the only business model I don't think that's ever existed like that, which is why I think it's so. It took a longer time for people to recognize how to evaluate these companies because they don't follow any traditional model. It's a completely unique thing. But now on that, because I mean, it's been fascinating listening to yourself and a lot of the talks that you've given, especially against the backdrop of Marathon's sort of a early position in terms of, like you said, you can't differentiate your Bitcoin. But there was an attempt to do that early on, not just by yourselves, but others as well. But that narrative has completely vanished. Which I would say was definitely a good, a positive development. And well, frankly, I mean, the model just never quite resonated or made a whole lot of sense to me. Simply, the simple means being, if someone wants to pay additional money for clean Bitcoin, then you could just, all right, sure, sell it, give us the extra premium, and then turn around and buy it on the spot market, and you've still got the same amount of Bitcoin. So that kind of arbitrage would kill that market before it ever got a chance to grow legs. Within Marathon, what was that transition like, coming to that realization and sort of pivoting and getting in line with the sort of the Bitcoin mindset?
It was a combination of we had spoken to financial institutions, and they said, you know, we want OFAC compliant coins because we can't invest in Bitcoin if there's a risk that the coins that we're holding are tainted. And so if you can give us coins that are fully OFAC compliant, and don't have any, you know, dirt on them, if you would, then we would be willing to pay more for those. So that was kind of the genesis of the thinking when Marathon started looking at doing their pool with the OFAC compliance. And DMG had already been doing this in Canada. And so it made sense that maybe people would pay more for OFAC compliant coins. In practicality, it doesn't work that way, because when you win a block and you're awarded coins, yes, the coins are virgin, but the transaction fees aren't.
That's the other.
So, right. So now, and as you know, there isn't such a thing as a Bitcoin. It's a ledger entry. So if you've received, transaction fees, and the minute we launched this, people started dusting our wallets.
Yes, which is so you got free Bitcoin as a result too.
Yeah, but people just wanted to say, see, it's not OFAC compliant anymore. So it just A, it wasn't practical. B, in reality, people weren't willing to pay for it. When you then went to them and said, hey, okay, now would you buy this Bitcoin at an higher price? It's like, no. So like many things, even with products people develop, on a day-to-day basis, just the market, A, wasn't ready, and B, I don't think everybody had thought through the implications. To your point, it needs to be fully fungible. You can't have differentiated Bitcoin. I think the big thing that actually killed the need for anything like this was the China migration. When China shut down mining in China, and you had this exodus from China of miners, all of a sudden the industry went through a cleansing is the wrong word, but it all of a sudden started becoming very institutionalized. The comment you made when we started this conversation earlier was that, the industry is growing up. Well, it is. It's becoming more institutional. It's becoming, all these public companies, you have all these serious investors investing, and we all have to do things in the right way. Just look at the whole ESG story, and how the narrative around energy and Bitcoin, and how the Bitcoin Mining Council came to be around the concept of trying to really do mining with renewable energy and really show the world that we are actually a big incentive for renewable energy to be deployed around the world. And power companies love Bitcoin miners as baseload customers because, you can take a couple hundred megawatts of Bitcoin miners behind the meter at a renewable energy plant. And if the grid needs extra electricity, they can just shut down the Bitcoin miners. And now you've got 200 megawatts going into the grid, as opposed to, I'm going to shut down this neighborhood's air conditioning systems.
Yeah.
And on the hottest day of the year, when everybody needs the air conditioning, you're shutting it off. So that demand response mechanism in the power grid is really impractical. Whereas having Bitcoin miners behind the meter is a very huge way of making baseload work much better for the grid and for the energy. And that also means that now renewable energy providers have an incentive to build out their capacity. Because, at the end of the day, in the US, we have excess energy. We generate too much electricity. And the problem is we can't store it. And so you blow up the grid if you put too much energy into it, which is why we have negative energy pricing 10% of the time in Texas, for example, where you're paid to take electricity versus you're paying to take that electricity. So there's no incentive for people to build new generating facilities if there's excess capacity. So Bitcoin miners are really driving the renewable energy guys to move forward and build renewable energy facilities because they have built-in customers. They're not dependent on transmission lines initially. So there's a whole economic reason why Bitcoin mining is going to be the single biggest incentive for renewable energy in this country. And I think you're going to see the benefit that comes from that as we accelerate the deployment of renewable energy in this country between now and 2040.
I do think that is going to be, the ESG thing, it blew up because of the whole Elon Musk thing. It's died down somewhat now, but I do think it is going to see a resurgence this year, namely because of the impending switch to proof of stake from Ethereum. I think that is going to reignite that debate. Mm-hmm. The reality is it does make the system as a whole, the energy grid as a whole, more robust. And I think we're going to get a chance to prove that in practice in places like Texas. Those events will be far more easily managed when you have virtual power plants like Bitcoin miners to be able. And the difference being is, like you're saying, because of the change in maturity of the market, you're dealing with participants who are good social actors. You're not talking about in China where they're mining in secret. They can't be called to turn off their machines because you're dealing with a totally different framework. But when you have cooperative agreements in place, then it makes the system more robust. The saying goes, Bitcoin fixes this because the fundamental principles that support and reinforce Bitcoin security can be applied to many, many different markets that only serve to improve them.
Absolutely. I think we're going to see a lot of deployment of layer 2 things like identity management. Microsoft rolling out their Ion network as a layer 2 on the Bitcoin blockchain. You'll see healthcare data. You'll see data migrate out of the application silos and onto the blockchain as users take control of their data. And I'm not talking just social data, but I'm talking corporate data, business data. By having it on the blockchain, this is a lot of Web 3.0, but by having your data on the blockchain, it's impervious to ransomware because you can't encrypt that data. It's already encrypted. Nobody can change it. You as the owner of the data control who has access to it. You essentially give somebody a permission or a token, if you would, that allows them to view it. So when you go to the doctor, you open up a window into your data. Doctor can look at your data. When that token expires, they can no longer see it. This is a way to never have data in motion, data in flight. Data only exists in one place. And that's huge values.
Yeah, and you're talking about a whole new world of cybersecurity. So now that was all fascinating. We got to get into the meat of all this stuff now that everyone I'm sure is listening to this for. Now, getting into the heart of it. I mean, right now I haven't looked at it since we started talking, but stocks are kind of getting murdered again today.
Mm-hmm.
I'm curious to know what your take is when things like this happen. Bitcoin's even up from yesterday, and then all of a sudden you get this massive reaction, stock sell off. What's your take on that kind of thing? Because I mean, there's a whole like in the retail community, it's there's a whole lot of the sentiment is definitely leans toward there's a lot of manipulation in the stocks versus crypto. In crypto as well, but it does seem to be more pronounced in the stocks. Generally speaking, how does the company look at that, or how do you look at it?
Well, the companies like ourselves or Riot, I mean, we trade upwards of 10 million shares a day. So, if you think about 10 million shares on our market cap, that would mean you'd have to be deploying $300 million of capital a day to move our stock around. So I don't think there's a lot of manipulation going on in any of the large cap kind of miners. It's different. A company like a TerraWolf that does 30,000 shares a day, yeah, you can move that stock pretty easily. But Bitcoin or Riot, I'm sure when Core comes public here in the next few days, the same thing there. There's going to be enough volume in the stock, so it's hard for retail buyers to really move it at all. If you look at Marathon, we're at any given point in time between 30 and 40% institutionally held.
Yep.
They're the big holders. So I think what people react to is, if Bitcoin goes up 4 or 5%, the impact to the miners is on the margin side, right? And then obviously our Bitcoin holdings can go up and down. What people tend to look at with the public miner stocks is kind of historically, people have been valuing, I think, this is just an opinion, miners based on future deployment and growth. And then they kind of look at what's the hash rate at today, what's Bitcoin at today. Wow, these guys are going to print a lot of Bitcoin, so I'm going to apply a certain value to a miner. I think what's happening now is people are realizing that you need to look at the impact of the global hash rate. You need to look at the fact that the price of Bitcoin isn't moving upwards at 10, 15% a month. It's going sideways here. We're in this sideways kind of chop in the 40s. And so the expectations on revenue that the analysts have are starting to come down because we're not seeing Bitcoin continuing to rise. We're seeing a higher global hash rate than what some of the analysts were predicting. I think you could look at the B. Riley estimates today. They revised estimates across their whole suite of miners based on the price of Bitcoin being different, the hash rate, et cetera. Right. So I think the whole industry is getting relooked at by people, and I think it's going to change. But at the end of the day, the stock prices are about where they were last year at this time.
Yep.
So it's not like, oh my God, the market's come down 70%. No, we're where we were last January, pretty much. And now it's going to be more prove to me that you can deploy all the stuff you're deploying, right? And that's especially in our story. I think what people are looking at is, is Marathon going to be able to deploy everything they have on order? And we're very focused on that. So right now.
On that note, let's transition into that. The obviously with you guys, you're the only miner that you're the only miner where it's very easy to get literally up to the second production results by just viewing the Mara pool on the blockchain. Obviously, you share that with DMG currently, but they do make up a much smaller percentage of that. So it's a lot easier to track that on a daily basis. So I know that Charlie spoke with me regarding some of the downtime things you've been doing at the Hardin facility, trying to get some upgrades done to make that run more reliably. We can see that especially near the end of the year, there appeared to be some more downtime. How are things going with the Hardin facility? When do you guys expect that'll be running at 100% on an ongoing basis, more or less?
Yeah, being a public company, we have to be careful how we comment on these things because it's kind of future perspective. But looking backwards, It's a coal-fired plant. It's a very modern plant. It was built in 2007, but it has its issues. And I think, they're busy. The folks at Beowulf are busy trying to work the kinks out of their power plant. And we had a shutdown in November where we had to do a massive kind of clean out of the cleansing facility. So if you think about how a coal plant works, and one of the reasons why we liked this plant was from an emissions perspective, you measure sulfur dioxide, for example, particulate, to 3 decimal points. So 0.000 is no emissions. The typical coal plant operates at about 0.01 or 0.2. The Hardin facility operates at 0.001 or 0.00. It's nearly immeasurable. It's white coal. It has a very extensive cleaning system which crystallizes the sulfur dioxide so it never goes out into the air. So it's one of the cleanest coal plants around. However, that cleansing process that crystallizes the pollutants, if you would, if the crystal particulate doesn't properly fall off I don't want to get into a deep technical discussion, but think of a pyramid where the crystal material sticks to the sides of the pyramid and then falls off. And then you essentially collect it at the bottom of the pyramid, you put it in bags, and you then deal with it as waste. If it's not falling off the sides of the pyramid and it accumulates, it starts forcing the plant to lower their capacity. And that's what was happening. So this particulate matter was getting stuck, wasn't coming off, so they had to shut down the plant and remove 40 tons of this material that had collected over time. And so that's been the issue with that plant. And, we believe we've worked our way through those kinks, but there's still some tweaking going on. So we'll have some up and down time. And then it's a power plant, so it tends to go operate generally very well, but every now and again stuff happens. You can get rocks in the coal mix going into hoppers that can then break a hopper. And so then now the motors that drive that hopper have to be repaired. And so you have to take capacity down a little bit. So it's all lessons learned as to why, if you think about why does Marathon want to be agile and not own hosting facilities, it's because we don't want to have to deal with these issues.
Yeah, and obviously, that's even the counterparty, and then that's the advantage to being able. Well, there's again trade-offs. Again, like we were talking about earlier, the benefit of being attached to the grid means that you're not dependent on any individual source. It's more distributed. But you guys have talked a lot about mining behind the meter, which would require you to be located at a facility. And reliant on that facility for continuous uptime.
Yep.
But you're behind the meter, so you could get better rates. With Compute North, that's you guys have just recently amended the agreement with Compute North to house the remaining roughly 100,000 miners overall. They're going to be distributed at various locations throughout the United States. I'm assuming some behind the meter, maybe some not, some in Texas, some elsewhere potentially. I know there hasn't been a whole lot of disclosures around that. But I guess I want to talk about Compute North and I guess that rollout going forward. I know that you guys have forecasted, mid around the first quarter of 2022 to be a major deployment of these miners. But in your last operations update, you had received 72,495 miners throughout the year from Bitmain. Currently at Hardin, it sort of currently installed 32,350. Vast majority of that is at Hardin, which is now at capacity. That leaves a remaining 40,145 miners currently waiting to be installed. That's over your existing entire capacity, which equates to roughly 4 exahash of additional power. That's literally just waiting to get turned on. what I guess what's holding this back? Because a lot of those have been delivered over the last couple of months. Are they like where are we with that?
So those machines are in the process of being deployed, and I think you'll start seeing when we do our January update, our February update, and March updates, you'll see that flow through the system pretty quickly.
Okay, so yeah, they're literally yeah. So obviously that was the play, is to get those things installed or expedite the delivery of those, so you have them now. What obviously the charting of the aircrafts to deliver those. What were you looking at otherwise if you had let those just work their way through the supply chain? Because that's one of the concerns out there, is that, okay, all that money was spent, they're here, but they're still not turned on. What was the alternative? How long was that going to take to get here?
Yeah, so the alternative was anywhere from 20 to 45 days of delays. So what we didn't want to be, and what we'd never want to be in a position of, is where there's where we have multiple constraints choking our ability to deploy. So right now, if you look at, we did the Compute North agreement in June of last year. We purposefully lent them the capital so they could order all of the switch gear, all the containers and everything for the deployment, so that wouldn't be a constraint point. We expedited the delivery of the machines so they wouldn't be a constraint point. And in reality, the additional cost to fly the miners ourselves versus not was about $100 a miner. It's not a whole lot of extra money, but it gave us peace of mind that we'd have the miners on the ground ready to go. So as soon as we could energize containers, we could deploy them. So we've already started deploying at the new facilities. That'll continue apace through Q1. It'll start really ramping, accelerating here towards the middle of the quarter and towards the back half of the quarter. And then it'll just keep going through the balance of the year. Because not only do we have these 100,000 miners, but we also have the additional 84,000 miners that we've ordered for delivery in the back half of the year. So you'll see in the near term here announcements regarding where and how those will be deployed.
Okay. And is there a preference for Marathon to focus on behind the meter, or say connected to the ERCOT grid in Texas?
So all of our go forward sites are predominantly behind the meter with a grid connection in addition as a backup. So again, lesson learned. We're going behind the meter because of the flexibility and the pricing, but we're adding a grid connection such that we always have backup.
Okay.
And realize that when you're in, and these are predominantly renewable energy sites, by the way. So wind and solar, we're not going, the bulk of this is not going through any fossil fuel or anything. This is renewable energy sites. So we're really focused on being carbon neutral in all of our operations by the end of this year. So by deploying a renewable energy site behind the meter, we act as that load balancer for the energy provider. But then we also have a grid connection for when we don't have access to renewable energy. And that grid connection in ERCOT, for example, has a very high proportion of it, which is renewable. And then the balance of that we offset with renewable energy credits.
Okay, interesting. Okay, from that, the partnership agreement that you have with Compute North, that's been amended a couple of times, and now it's at I believe 4.4 cents per kilowatt hour, which is certainly a respectable. And this plays into your asset light approach. When you've talked about this in terms of how what you bake into that overall cost in terms of that infrastructure, and how the only way you can evaluate that is by depreciating that infrastructure. My understanding here, and I guess you can speak to it a little bit further, the Hardin facility, you guys are depreciating that on a 5-year basis. Depending on the type of infrastructure, I guess it would depend on how rapidly you depreciate that. I would imagine, the Hardin facility has a longer than 5-year lifespan, even with its existing equipment.
Yeah, you have to look at it based on the duration of the hosting agreement. Remember, we don't own the power plant. We just buy power from the power plant. The data center agreement with the power plant is for 5 years. So we have to depreciate the data center investment over 5 years because there's no certainty that that data center will operate beyond that 5-year period. And this is, it gets into
It's
accounting
accounting.
and tax.
It's just accounting.
It's accounting, right?
Yeah.
So if you kind of do the math on it, you'd say, well, between energy and hosting costs, and this is all public information in the contracts, it's about 3.8 cents all in when you look at the energy and the cost operating the hosting. If you then add the depreciation for the data center, where we've spent a significant amount of money to buy containers, switch gear, et cetera, that depreciation takes the actual cost per kilowatt hour to about 4.5 cents a kilowatt hour. So our cost with Compute North is actually about 0.09 cents less than our cost to operate Hardin. And we have no CapEx requirement other than the miners, so think about it this way. In Hardin, we've invested over $30 million in infrastructure that essentially we're writing off over 5 years.
And so now there was one in the recent filing with the SEC where there was a slightly different model on I think it was the last 30,000 or so miners, where you guys had set up a joint venture between Compute North and Marathon. How is that set up?
So that just has to do with, there's a very small portion of the miners that the energy provider is actually going to be using for their self-mining, we can say. So we're doing a joint venture with the energy provider. So this is essentially a joint venture between us, Compute North, and the energy provider, such that they're able to mine their own Bitcoin.
Okay. Interesting. Okay,
if you've been following my kind of presentations at some of the conferences regarding power companies, this is kind of how power companies are going to operate going forward. You're going to see power companies being very focused on owning a certain percentage of the mining capacity and mining for their own benefit.
So, what kind of contribution, I guess, do they? Or is it just providing that cheap power?
Well, yeah. So think about it. The single biggest input cost to Bitcoin mining is power. So if you can get subsidized power by partnering with the energy provider, then you're going to have an overall lower cost of mining Bitcoin.
I think the biggest takeaway from that kind of those kind of developments is that, again, it's further evidence that the industry is maturing because now you have well-established legacy power generation companies that want to become a part of this. They're not going to do that if they think it's not going anywhere.
Exactly. So I think what you're going to continue to see is, Bitcoin mining is the constraints around capacity and machines are going to disappear over time. And what that means is that the only limit to your ability to mine is going to be access to capital. I think there are enough public companies today in the mining space that it's going to get harder and harder for people to go public as miners because the margins over time, as the constraints disappear, the global hash rate will grow to the point where the profitability in mining will drop to be 30 or 40% over time. And by over time, I mean over many years. And at that point, it's about enough to support the renewal of machines every 5 years, right? If you're not earning 30 or 40% margin, you're not going to be able to do that. And so what ends up happening, the beauty of the Bitcoin blockchain is miners will grow capacity as much as they can. And then there comes a point where it's not economical to grow capacity and people start shutting things off. And so the hash rate will go up and down in relationship to the profitability of the business, as it always has. It's just we're in a cycle right now where you have a lot of new capital coming into the business. There have been these constraints around availability of hardware, availability of hosting that have held back the hash rate from exploding. You had the transition out of China, which kind of delayed the increase in the global hash rate. And now what you're going to see over the course of 2022 is the hash rate double. And so if the way we look at it is, you have to look at your cost of mining a Bitcoin, right? Our cost of mining a Bitcoin is around $6,000. When you look at energy, hosting, depreciation on the hosting, all in, right? It's not the depreciation on the miners, but everything else, right? So at about $6,000 a Bitcoin in 2021 terms, at the end of 2022, you have double the global hash rate. Your cost to mine a Bitcoin is arguably $12,000.
Yep.
In 2023, you have a 50% increase in the global hash rate. Your cost to mine a Bitcoin is $18,000. And then in 2024, you have a halving, so you get half as many Bitcoins. So your cost to mine a Bitcoin just doubles, right? And so now you're at $36,000 to mine a Bitcoin. So the price of Bitcoin is going to have to be, well north of $70,000 a Bitcoin in 2024 for, mining to still have that north of 50% margin in it. Now that's Marathon's model. Now let's look at somebody paying 6 cents a kilowatt hour. So $10,000 to produce a Bitcoin today times 6, do the same math, right? Times 6, that's $60,000 to produce a Bitcoin. That miner who's paying 6 cents a kilowatt hour. So think of all of Riot's and Core's customers. Those guys are paying 6, 7, 8 cents a kilowatt hour. Those guys are going to be producing Bitcoin somewhere between $70,000 and $100,000 a Bitcoin cost. That doesn't include miners or the depreciation of miners. We're at $36,000 a Bitcoin.
Yep.
So what do you think is going to happen come 2024? There are going to be a lot of people who are paying 6 and 7 and 8 cents for hosting who aren't going to be able to afford to be mining unless Bitcoin continues to go, north of 200,000.
And that's that of course, that is the golden question is, trying to predict what Bitcoin's going to do over the next 4 years has never been I don't know anybody that's been very good at it, despite the cycles. But now what we're looking at is, again, a change in the incentives. So Bitcoin's behavior over the next 4 years is going to be very difficult to predict, especially now that it is a maturing market. I don't think we're going to see the same drawdowns that we've seen before, but we also might not see the huge blow off tops that everyone's become accustomed to. It does not behave the same way because the products and like financial products available in the market are just different than they were before. It's a change in the incentives. So I guess what you're getting at though is the time to grow is now. As aggressively as possible is to grow as quickly, get as big as you possibly can, because the incentives exist today to let that happen. If you wait, and the hash rate has grown and those margins get compressed, there's the availability of capital it's going to dry up. And despite what happens between now and then, once you're big, you can remain profitable regardless of what the price does. If Bitcoin's price drops, difficulty will drop with it, because other miners that can no longer be profitable are forced to shut down, which then makes you more profitable. And you can only really accomplish that by being as big as you possibly can. Obviously, that could lead us down that whole rabbit hole about centralization of mining, which just sort of reconstitutes itself into public companies, which it's probably headed in that direction because that's the nature of these systems. But I guess you don't have to. I don't know. What are your thoughts on that quickly?
Listen, at 23 exahash in early 2023, we'll still only be 6 to 7, 8% of the global hash rate, and will arguably be one of the biggest miners. So you take Core, ourselves, Riot, add a couple others in there. We're all still. I mean, today all of the Bitcoin miners that are public added together represent about 12% of the global hash rate when you add us all together. Fast forward a few years, we may get to 25%, something like that. I think there's still plenty of decentralization. out there. I think it would be very hard for anybody come 2024 to be north of 10%, any single miner.
Yeah.
And I think the market's just going to make it harder. Market is going to make it harder to grow over time, to your point. You need to be deploying capacity now when the reward rates are high, because come 2024 or even 2023, just think about it. Your costs are going to double over the next 12 months, right? So your time to pay back the machines you're deploying is going to stretch out, which means your ability to raise capital to buy more machines to continue to grow is going to stretch out. So it's grow, deploy capacity as soon as you can, such that you have the Bitcoin that you can then use to whether generating yield or you're borrowing against it, or God forbid you sell it. So you have a way to kind of fund your operations longer term. But I think the dynamics in the industry are going to change. I think the cycle is changing, to your point. We don't have people using 100-to-1 leverage, using Bitcoin as the collateral for their margin. So you don't have this ease of people manipulating the price of Bitcoin by blowing through stops and pushing the price down 80% and then buying it right back up again. That ability in the marketplace, I think, has disappeared. You've got, arguably, based on Glassnode's kind of numbers, 13 million BTC in long-term holders' hands at this point. So your liquid supply is only about 5 million BTC. And with the miners not selling, you have no new liquidity coming onto the market. So it's really easy just to look at what's going from, off-chain to, what's going from cold storage onto exchanges and back again. You can see exactly when people are going to buy or sell by looking at that dynamic. And I think, there's going to be a lot of resistance to get north of the 51,000 price point, where kind of is the break-even point on a lot of the Bitcoin that traded hands more recently. So I think we're going to be in a sideways chop for a while, and that's going to be really interesting for how companies that want to grow are able to grow. We were, I think, very lucky, and our definition of luck is good preparation meets an opportunity. We raised this convertible debt offering and had the cash to be able to place this very large order we placed with Bitmain recently. So we were in a position to do that. I think it's going to be harder for somebody if Bitcoin keeps operating in this range and the stock prices keep doing what they're doing now, for people to raise capital to go try and do something like that.
Mm-hmm. Yeah, that's one certainly. I mean, the timing of that debt offering could not have been any better. That was quite remarkable, and how quickly you were able to do it and put it to good use. So it's going to be, like I've said before, it's going to be a pleasure to watch Marathon grow throughout 2022. I think it's going to be a signature year for how things are going to play out in the coming years. But the reality is, you're building a company that you're looking beyond just what happens this year or next. Mm-hmm. It's 2, 3, 4 halvings from now. Yep. What is the space going to look like? And the opportunity is now to do exactly what it is you're doing. Mm-hmm. And I do think that that's going to set it apart and set the stage for what that space is going to look like 5 or 6 or 10 years from now. It's I mean, again, you go back to the basics and the fundamentals and the use cases that keep developing. It's hard to deny the premise that we're all sort of anticipating to come next.
Yeah, I think longer term, what we're going to see, I think, I forget who it was, but one of the famous kind of management gurus had often said that innovation and disruptive technologies sneak up on us. And again, the iPhone, when it was launched, wasn't viewed as either disruptive or innovative. Most people thought, it's an iPod that you can talk on. You can't develop software because it's a closed ecosystem. Now, Apple changed that, and it became what it became. But I think what you're starting to see, there's been an appearance of not a lot of innovation in the Bitcoin world and a lot of innovation with other protocols and platforms. But as people start looking at, gosh, look at how many Lightning node channels exist now all of a sudden. And you're starting to see this kind of slow seeping into the ecosystem of Bitcoin and blockchain-based systems. I think 2022 is when we're going to start seeing the banks start rolling out bank accounts with Bitcoin wallet capabilities. You know, you're familiar with this announcement that NYDIG did with FIS last year, essentially that will prepare any bank that's on the FIS platform will be able to offer a digital wallet to their customers that they can hold crypto in, Bitcoin and Ether, I think primarily, and buy it and sell it and custody it through NYDIG. So when that happens, now you're starting to see adoption at the consumer level in a very different way. A lot of people think, well, people aren't buying things with Bitcoin. You know, that's not true. Go talk to a realtor in any high-end market. I was talking on the phone yesterday with somebody in Dubai, and they said 1 out of 3 cars sold at the exotic car dealerships in Dubai are sold with Bitcoin, paid for by Bitcoin. Think about that. 1 out of 3. There's a story about a guy who paid $3 million in Bitcoin for a Bugatti. You know, so this is starting. The transactions are starting to happen. People are buying homes, apartments, planes, yachts, high ticket items with the advent of stable coins and Lightning-like channels now, and MasterCard rolling out credit cards where you can hold your crypto and essentially they'll pay the merchant in fiat and they'll just deduct it from your wallet. The whole tax reporting issue becomes much more simplified. And as soon as you remove the friction in the use of Bitcoin and other digital payment forms, then you'll see this really explode in a really unique way. And I think it's going to be a very, the next 5 years, I just liken to 2000 to 2005 in the internet, when you just all of a sudden went from, hey, you can browse some websites and there's some rudimentary e-commerce, to all of a sudden now you can stream videos, YouTube launched, kind of all these things launched, and then the iPhone happened and it all just exploded. I think the next 5 to 10 years are going to see some great advancements. This year we'll see regulatory clarity on DeFi. We'll see regulatory clarity on stable coins. That'll hopefully stabilize those businesses. So now, consumers will start operating them. As that grows, that'll just drive more adoption of crypto overall.
I think I would agree with that. And there's, I mean, that's a whole nother conversation I'd love to spend a lot of time on, maybe at another point. But I wanted to get a little bit more into, again, you mentioned a couple of things a little while ago. Marathon is involved in there was the Bitcoin Mining Council. Has that gone anywhere since, because we haven't really heard much from that organization over the last little while. What's happening there?
Yeah, I mean, the purpose of the Bitcoin Mining Council was to educate the marketplace regarding Bitcoin mining and energy use. And so we publish each quarter the numbers regarding, what the total amount of exahash of members, what percentage of the energy used is carbon neutral versus not.
Okay, so
and then a projection. So we keep doing that. That's going to continue happening. What happens behind the scenes is more what you're starting to see from groups like the Digital Chamber and Perry Ann Boring in Washington, who are working closely with regulators in trying to do things like the Public Accounting Board and how Bitcoin is treated. Today, it's a long-lived intangible asset. So for companies to hold it on your balance sheet, you can only impair it. You can't mark it to market, which is a detriment to companies holding their assets in Bitcoin. So if you could fix that accounting treatment, and that doesn't require any regulation. That's just the Public Accounting Board having to make a change in how they view it. The IRS doesn't care. They collect taxes on it regardless. So they're happy with that. And so that needs to happen. The taxation, potentially treating Bitcoin more like a currency as an asset class from a taxation perspective. For example, if you have an account in euros as well as dollars, you have to declare that you have that foreign bank account, but you're not declaring the gain and loss on the euros in that account compared to the dollars. The same thing we would want to have apply to people who have crypto in a wallet, that when you spend your crypto, it shouldn't be a capital gains transaction, right? It should, once the crypto's there, if you've bought it, then it's a currency just like any other currency. And when you spend it, you're not declaring it up to a certain amount, obviously. Companies that hold more than a certain amount of digital assets are going to have to declare the gains in them anyway. But for the consumer, there should be some level where a consumer doesn't have to worry about a tax declaration at the end of the year for every bus ticket they bought using Bitcoin. What's the stopgap? Well, the stopgap is you have your assets in Bitcoin, you convert to a stable coin once a month, and you pay your bills using that stable coin. Therefore, it's only one taxable transaction from an accounting perspective and from an IRS perspective as a consumer. But all that needs to get worked out. And as we start working out the practical aspects of it, then the friction in using digital assets disappears. And the minute that happens, you get really broad adoption very quickly.
I think you're touching on an interesting conundrum in the Bitcoin space, because while it has a lot to do with where Bitcoin got its beginnings, its origins. It was very, very a little archaic, and they liked it that way. They liked that it was outside government, outside institutions. But at the same time, you want adoption, and Bitcoin has reached that level of maturity where, especially in the United States, is just now starting to come to terms with it. But at the same time, because like we said before, it's so vastly different from anything that's existed before. It's that transition to getting regulators to even understand it, let alone understand how to treat it and its transactions. It's going to be a bumpy road, and then having someone like an organization like the Bitcoin Mining Council might provide a means of advocating for what the community wants, because I think Michael Saylor said it best. We can be decentralized doesn't mean we have to be disorganized.
Exactly. Yep.
But it is kind of like closing turning the page, or closing that chapter of Bitcoin's history where it was outside. It was this whole separate world, and some want it to stay that way because they figure the government's going to come in and just mess it up. But there's, again, further to what we were saying, there's always trade-offs. You got to if you want something, you got to give something, and that's Bitcoin. That is how it's designed, and that's what I think ensures its success. But it means that everybody has their own way of looking at it and what this is going to become. How it's going to get there, well, that's the part none of us really know, or what final form it will take, because it's going to morph somewhat in terms of just in different places are treated in different ways. As we see El Salvador, it's not taxable at all under any means. So if that's what you like, you can move to El Salvador.
Well, I mean, you can live in Puerto Rico, and there's no capital gains federally there, so you can do quite well there, provided you want to live there. I mean, great climate certainly. Mm-hmm. But I think you're going to see other countries again, back to this concept of innovation disruption happens kind of from the bottom and percolates up. You're going to see other dollarized economies start looking at Bitcoin as a potential tool for, look at Turkey. The single highest adoption of cryptocurrencies in the world on a per capita basis is happening in Turkey. Why? Well, because the currency is depreciating at this huge rate. People need to hold their assets in something, and they don't necessarily want to hold it in dollars. So, why not hold it in crypto? So I think you're going to start seeing more and more countries with sort of dollarized or economies where their local currency is either highly inflationary or otherwise. Venezuela, Turkey. You're going to see potentially other Latin American countries, some countries in Africa possibly, as an alternative to the dollar. I think you're going to also start seeing certain countries wanting commodities to be priced in currencies other than the U.S. dollar. This is something that gets into this whole concept of the U.S. dollar as a reserve currency. There is a benefit to the U.S. from a geopolitical perspective in having the currency be the reserve currency, but there's also a huge cost to it in that the U.S. has to print a lot of currency, a lot of money. You have to keep a lot of liquidity in the markets for the U.S. dollar to be a reserve currency. Oil is all priced and denominated in dollars. So there's certain power to that. But at the same time, I think you're going to start seeing certain countries that are large exporters of commodities looking at the dollar and what's going to happen to it relative to its actual purchasing power and saying, maybe we should look at an alternative currency for denominating our commodities. The biggest threat to the US dollar as a reserve currency is the euro. It's not the Chinese yuan, because that's subject to currency control, so it can't be a reserve currency. But as more trade is done in other currencies than the dollar, and over time, the dollar has been decreasing the amount of trade that's done dollar denominated versus in other currencies. And the euro is the single biggest competitor to the dollar in that regard. I have to but wonder that there's some people in Washington that might be thinking, if a fully decentralized currency like Bitcoin that nobody controls were a reserve currency, then there's no geopolitical power in it. If the euro becomes too much of a reserve currency, then the Europeans have a lot of power. By the same token that people don't want the U.S. to be the only reserve currency because it gives the U.S. a lot of economic power. Well, a decentralized currency would be the only way that there could be trust in a reserve currency because nobody controls it.
Yeah, that's touching onto a huge macroeconomic backdrop into how what you're talking about. In my opinion, I think it's maybe a multi-decade outlook in terms of how this might play out, and it really does depend on really how Bitcoin evolves. It would have to be a whole lot more stable than it is now, which means a whole lot bigger than it is now, and maintain its decentralization, where one, at that size, you can't manipulate it no matter what you do or how much you've got. And the reality being, if the decentralization of its ownership is spread out amongst enough of the, G8 country, whatever you want, the mega powers, the mega economies of the world, if it was distributed enough throughout that, then it would be a fair baseline. It would be a fair foundation to build everything else on top of, because then everybody else, everyone's playing by the same rules and nobody's holding the keys, as it were.
It's definitely a long-term game. Bitcoin is a long-term business from a miner's perspective because the last Bitcoin won't be mined until 2140. So there's a lot of halvings between here and there, if you would, for that to happen. I think the other thing is, if you look at the average amount of Bitcoin held in wallets, that number is decreasing, which is a very good thing because it means there are more and more wallets holding Bitcoin, which means essentially there's more and more decentralization of the holdings happening over time, which is, to your point, a very good thing. As Bitcoin becomes more and more distributed and potentially becomes maybe more of just a staking tool, who knows? But I think we're going to start seeing things being priced in Satoshis versus Bitcoin. Because
even now,
right. I mean, it's and Michael Saylor has talked about some really interesting things regarding using Bitcoin as a way to and essentially staking as a way to deal with things like trolling, deal with spam, things like that. So, hey, if you want to send me an email, you're going to have at least 100,000 Satoshis staked for my email client to receive an email from you. And that means that if you spam me, I get that 100,000 Satoshis. Guess what? Spam would cease instantly with that.
It's funny because what you're describing, proof of work, was originally, there was a thought that a form of proof of work was created to solve that exact problem of spam, because you have to do this computation in order to send it. And for one person to send that message, it's no big deal. But if you want to spam 1 million addresses, well, suddenly you have to expend all this power just to do it. Yeah, again, the incentives change. That's where proof of work was originally created, a form of it, anyways, not the existing model. But again, like, I'm curious because you've got a very broad and high level of knowledge about Bitcoin, its underlying. What's been your journey? Where do you source your information and when you're looking to understand all of this? Because it's not like there's a course. Well, I'm sure that there are courses you can take, but the reality is it moves so fast that any course you might take is already outdated by the time you take it. How have you come to develop your understanding of it?
So, I mean, part of it was, by way of background, I come from a family of bankers and people in the banking regulatory framework. So my dad was a banker who was very involved in the funding of the North Sea oil build out, and he worked for a number of banks and was responsible for managing a lot of the capital raising that was done for the North Sea oil deployment. And so I grew up where dinner table conversation was around, economies, the economics of commodities, the economics of, the oil industry. How does the oil industry work? How do you look at project finance, and how do you look at return on assets? My stepmother was a senior economist for the OECD, responsible for writing the regulatory frameworks for Russia and the East Bloc countries to come into the OECD after the wall fell. And so, again, dinner table conversation all around stock trading, all the regulatory frameworks. If you could design a whole new banking framework, how would you do it? So I grew up in that kind of world. My first software programming job was for a bank in London in the 1970s when I was in high school. And this was at a time when banks in England still, when you went to cash a check, there was a handwritten ledger at the teller used to write the check and the transaction in that later was loaded into a computer. So I lived through that transition of banking and just the inefficiencies that exist in the banking framework. And so as I kept sort of operating in the technology industry, I was constantly just kind of thinking about this problem that money and how money moves is very impractical. And then as we looked into the post kind of Sarbanes-Oxley world, and we looked at especially the post 9/11 world, money became even harder to move because you had now KYC AML issues and money laundering issues. And so when Bitcoin started appearing on the radar screen, I had a CTO that worked for me at one of the companies I was running. And, we started just having these debates about, Bitcoin and what problem could it solve? What could blockchain solve? And, being a technologist at heart, I was very focused on what blockchain could solve, less about Bitcoin as a currency, more about blockchain and Bitcoin as a technology to enable instantaneous payments and settlement, to deal with trust issues. And in about 2016, I became chairman of a European company that was one of the top encryption companies around what's called root of trust. So the German company that made a device called a hardware security module. Think of it as a hardware wallet on steroids. This is where the three-letter agencies and the military store their keys. This is the absolute highest end key storage system that you could imagine. Literally James Bond-esque in that if you touch it, it would melt and all the data inside it would disappear. That's how sensitive these things were, so that nobody could hack into them, totally air gapped, et cetera, right? And in looking at that, again, started thinking back about blockchain and had the opportunity to get involved in starting one of the first licensed OTC desks in Liechtenstein, and built an escrow service in Switzerland for dealing with crypto transactions. And through that, was very involved in the early stages of the regulatory frameworks that were designed around crypto, especially in Liechtenstein. And our company was the first licensed entity that could trade Bitcoin legally, if you would. That taught me a ton about kind of the capabilities, but also the issues around the risks around what platform you were using, smart contracts, and how not to write smart contracts, and so on. So when Marek, my predecessor, got involved with Marathon, I'd known Marek for 20 years. Our kids had grown up together and we'd been close friends. He said, hey, I need somebody who understands blockchain on my board. So I joined the board in 2018 and worked together with Marek to get Marathon kind of where we are today. And so for me, it's just been this long-term journey of, I'm a believer that technology can solve all sorts of problems. And blockchain technology, in my mind, is the perfect evolution of the internet, and where everything, we're going to move to a world where we can be fully decentralized. Even power generation is becoming decentralized. With solar power today and energy storage, you can do community level power, where a community in a state that has enough of the right solar footprint could easily deploy solar panels on all the industrial buildings in a particular area, take that energy, store it in batteries, deploy it to homes within a certain radius. Now you're moving away from the grid as a power distribution network and only using the grid as a load balancing system. So if you need some more power somewhere else, you can ship it from point A to point B, which is, by the way, what the grid was originally designed to do. We have centralized power generation designed to provide power to people around it, and then you only have to touch the grid actually to move from one generator's utility to another. Today, the grid is being used to transport electricity all over the place, and it's just not designed for that. And so we need to move to edge power generation, which becomes really economical now with the cost of solar having come down, the cost of batteries having come down. And if you add just a little bit of Bitcoin mining at those edges, all of a sudden you can fund the development of that solar power or renewable energy. And more importantly, you can subsidize it. And so Bitcoin mining starts becoming an enabler for this edge energy deployment. And so imagine, instead of a huge solar farm located in the desert where you're now going to have to ship electricity hundreds of miles to civilization and your consumers, you have that generation on every rooftop. You clad towers, buildings in solar panels so that they generate their own electricity. They sell the excess energy into the buildings around them, and you get this edge generation. It's kind of just like in the AI world with computational engines at the edge. Otherwise, if you're going to do all your AI computations and operate your models in the cloud, you have to take data from the edge and ship it up into the cloud, get the computation, get the results, ship it back down to the edge where it's acted on. That's very inefficient. And the internet isn't designed for that sheer volume of data moving up and down, on and off the internet, if you would. But if you do the computation at the edge and you're just shipping the insights, the learning, if you would, it's a much smaller data package. So think about how content distribution networks are built today, right? You can watch your streaming on YouTube because it's not located on one server. Your program is located on tons of content distribution networks that are near to the edge of the network. So they're only actually transporting it. The user's actually streaming it off a node from an Akamai node, for example, which is nearby. It's not having to ship from one central server. That whole architecture is what's going to happen to the power world. And especially as we get to small modular nuclear down the road, I'm not saying in 5 years, but 20, 30 years from now, there will be the ability for people to generate electricity using some form of renewable other than just solar and wind. Might be hydrogen, might be small nuclear, but that is clean and safe enough so you can have communities generating all their own power. And this is where I think some really exciting stuff that is going to come out of blockchain and come out of the crypto world and Bitcoin mining. We're going to end up funding a lot of those developments because that's what's going to drive true energy independence at the community level. not just at the national level, but the community level.
I can tell you got definitely bit with the bug because, yeah, your mind cannot help but go to those use cases that don't exist today, but you see the potential. And a lot of what you're saying plays into Tesla's goals around solar roofs, solar roof tiles, which they've certainly pioneered. And while, again, still fairly costly today, the trend is only headed in one direction.
Yep.
And it's not necessarily practical in every climate. Where I am, all of our roofs are covered in snow for half the year, but a large percent of the population doesn't have that same issue. But the point being is that the more you can distribute that power to the edges, and the reality is it would be very difficult to do that with any of the existing financial models that we've had in the past, because what does every person now have to keep track of that, or all that information would have to be stored in a centralized way that someone would have to be able to run? Blockchain would completely eliminate that, where you could tokenize that energy and trade it back and forth, and you add Bitcoin into the mix as well for people to pump that excess into that and store that energy in the form of Bitcoin. Again, like the possibilities just don't end, and it can be hard for a lot of people to imagine what that world would look like. But I think it will be like 10 to 20 years from now. We'll look back and we'll wonder how the heck we were doing it any other way, much like before the internet.
I'll just think about it. Yesterday, the BlackBerry network was shut down permanently. It wasn't many years ago that the BlackBerry was the key executive communication device. The iPhone was viewed as a toy, right? Today, the iPhone rules, Android rules, right? Smartphones rule. And those devices have been totally shut down. People think these trends take decades, but these curves accelerate. The iPhone's only 14 years old at this point.
It's about as old as Bitcoin, just 1 year older.
Yep.
Yeah.
So if Bitcoin adoption follows internet adoption curves, iPhone adoption curves, et cetera, then the network effect is going to be huge it's going to be exponential over the next 5 years. And that adoption is going to drive a lot of deployment of solutions, applications, use cases for crypto, which are going to drive just a further increase in the value of all of these various protocols and networks.
Well, I want to thank you. You've been very, very generous with your time. I've very much enjoyed this conversation. There is one more thing I wanted to talk to you about, and that is we touched on regulations and your views on all of that and where things are headed, and that this year is probably going to be a big year for that. What are your views on the Bitcoin spot ETF and the delays that they keep pushing those approvals back and then denying others, citing the same thing over and over again? Where do you think we are with that? And how does this play out? How do we get from where we are to where we all think we're headed, where the United States finally accepts and starts to embrace the Bitcoin on ETF products?
So I think the challenge that the regulators have is, if you think about liquid supply being 5 million BTC, right? 13 million are held in long-term holders' hands today, according to Glassnode. So 5 million in liquid supply. You have an ETF that receives $1 billion of inflow of funds. They have to go buy $1 billion in Bitcoin, right? Because that's the way an ETF works. You get 100 million, you get $1 million deposit, you got to go buy $1 million of Bitcoin right away. And they have, a certain number of days to balance their books, if you would. And so each time one of these funds starts, it's going to drive the price of Bitcoin way up because there's going to be demand all of a sudden, and there is no supply. It's, supply, you're going to have to buy Bitcoin from people who are currently holding it because there isn't new supply coming to the market. And so the price will go up, and then the price will sit once that ETF has bought everything it's bought, then you're going to have people selling into that demand, and the price will likely trickle downwards. So what the SEC is very afraid of is that you create financial instruments that move markets. In the equities markets today, $1 billion ETF won't really move the market as a whole. It may move one stock, but it won't move the whole market. The problem is an ETF tied to Bitcoin will only move the Bitcoin price up and down. And you just look at the Galaxy Trust, for example, and the fact that it can trade at a premium or a discount shows the kind of inefficiency in the marketplace. And the easiest ETF to get appointed or approved, I think, would be converting Galaxy into an ETF, because they're by far one of the single biggest holders of Bitcoin today. Mm-hmm. And the minute that turns into an ETF, I think that's an easy one because they don't have to go buy the Bitcoin. They already have it. And so there would be less market risk there. But that being said, I just think there is concern regarding the lack of liquidity in the marketplace. And, the Canadians have been very much more forward thinking with this. I think you're going to see ETFs for Bitcoin appear in every market around the world over time. And the regulators in this country will finally just bite the bullet and approve it. But what I think they're trying to do is, what are the rules and the regulatory framework you have to put around how this fund will operate such that it can't manipulate the market?
Yeah, it's I've been researching this a lot myself, and the argument of manipulation does seem a little bit rich, considering we have it in existing markets. It's just kind of baked into that cake as it is. But I do think it's different because Bitcoin is international. A large amount of the exchanges are outside the jurisdiction of the SEC or any other United States body. So they are limited in what they can do in that power, and on top of that, who's going to be responsible for it in the first place? It took a long time for them to decide to even come to terms with what Bitcoin is. But further to what you're saying, I think that they'll soon come to realize that a little bit of control over these markets is better than none at all. Yes. By pricing yourself out. Mm-hmm. So they're going to have to come to terms with it. And I do think that there's enough attention on this now, and the intentions of, I'm trying to recall which fund it is or which application. I'm not sure if it was Galaxy, like you were just talking about, that got delayed until I think it was February 2nd. I actually have those in my notes here somewhere, but they are planning on basically suing the SEC if they deny it this time. And that, as it turns out, is somewhat how the first ETF in Canada got approved. It was denied and appealed, and that appeal is how they won. So I think the States is getting to that, and that's what I predict is going to happen over this next year. Is the maturing space is going to get a lot more organized and more aggressive in advocating, what the community wants, and they have the means to do it now. So, be interesting to see how that goes. Yeah,
it's going to be very interesting. But I think that there are lots of other proxies. Institutional investors. They've invested in miners as a proxy. They've invested in MicroStrategy as a proxy. I think the one thing that's definite is that the millennials are viewing crypto as their version of gold, if you would. So I think, if anything, long term, I'm definitely a gold short, and obviously Bitcoin long. But I think what we're going to see is a shift that's generational as well, happening at the same time. So it's going to be very exciting times. I think this is going to be a watershed year. And, I really look forward to revisiting this conversation, later in the year or maybe early next year and seeing, what did we think was going to happen and what actually happened. It'll be interesting to see.
Well, it's always fun to those predictions. I got a video coming out on that with a few of my own. You'll see how well it ages.
Well, can't wait to hear it.
So yeah, again, thank you very much for your time. Before we go, is there anything else you wanted to add?
No, just really appreciate the opportunity to be on. Appreciate your support for Marathon and for the industry and the effort you put in. I know it's a lot of hard work, so thank you.
All right. Thank you.